Section 19 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. The regulators. Oh, I see. During the 1990s, various federal agencies had taken increasing notice of abusive subprime lending practices, but the regulatory system was not well equipped to respond consistently and on a national basis to protect borrowers. State regulators, as well as either the Fed or the FDIC, supervised the mortgage practices of state banks. The OCC supervised the national banks. The OTS, or state regulators, were responsible for the thrifts. Some state regulators also licensed mortgage brokers, a growing portion of the market, but did not supervise them. Despite this diffusion of authority, one entity was unquestionably authorized by Congress to write strong and consistent rules regulating mortgages for all types of lenders: the Federal Reserve, through the Truth in Lending Act of 1968. In 1969, the Fed adopted Regulation Z for the purpose of implementing the act. But while Regulation Z applied to all lenders, its enforcement was divided among America's many financial regulators. One sticking point was the supervision of non-bank subsidiaries, such as subprime lenders. The Fed had the legal mandate to supervise bank holding companies, including the authority to supervise their non-bank subsidiaries. The Federal Trade Commission was given explicit authority by Congress to enforce the consumer protections embodied in the Truth in Lending Act with respect to these non-bank lenders. Although the FTC brought some enforcement actions against mortgage companies, Henry Cisneros, a former secretary of the Department of Housing and Urban Development, or HUD, worried that its budget and staff were not commensurate with its mandate to supervise these lenders. "We could have had the FTC oversee mortgage contracts," Cisneros told the commission, "but the FTC is up to their neck in work today with what they've got. They don't have the staff to go out and search out mortgage problems." Glenn Loney, deputy director of the Fed's Consumer and Community Affairs Division from 1998 to 2010, told the FCIC that ever since he joined the agency in 1975, Fed officials had been debating whether they, in addition to the FTC, should enforce rules for non-bank lenders. But they worried about whether the Fed would be stepping on congressional prerogatives by assuming enforcement responsibilities that legislation had delegated to the FTC. A number of governors came in and said, "You mean to say we don't look at these?" Loney said. And then we tried to explain it to them, and they'd say, "Oh, I see." The Federal Reserve would not exert its authority in this area, nor others that came under its purview in 1994, with any real force until after the housing bubble burst. The 1994 legislation that gave the Fed new responsibilities was the Homeownership and Equity Protection Act, or HOEPA, passed by Congress and signed by President Clinton to address growing concerns about abusive and predatory mortgage lending practices that especially affected low-income borrowers. HOEPA specifically noted that certain communities were being victimized by second mortgage lenders, home improvement contractors, and finance companies who peddle high-rate, high-fee home equity loans to cash-poor homeowners. For example, a Senate report highlighted the case of a 72-year-old homeowner who testified at a hearing that she paid more than $23,000 in upfront finance charges on a $150,000 second mortgage. In addition, the monthly payments on the mortgage exceeded her income. HOEPA prohibited abusive practices relating to certain high-cost refinance mortgage loans, including prepayment penalties, negative amortization, and balloon payments with a term of less than 5 years. The legislation also prohibited lenders from making high-cost refinance loans based on the collateral value of the property alone and without regard to the consumer's repayment ability, including the consumer's current and expected income, current obligations, and employment. However, only a small percentage of mortgages were initially subject to the HOEPA restrictions because the interest rate and fee levels for triggering HOEPA's coverage were set too high to catch most subprime loans. Even so, HOEPA specifically directed the Fed to act more broadly to prohibit acts or practices in connection with mortgage loans that the board finds to be unfair, deceptive, or designed to evade the provisions of the Act. In June 1997, 2 years after HOEPA took effect, the Fed held the first set of public hearings required under the Act. The venues were Los Angeles, Atlanta, and Washington, D.C. Consumer advocates reported abuses by home equity lenders. A report summarizing the hearings, jointly issued with the Department of Housing and Urban Development and released in July 1998, said that mortgage lenders acknowledged that some abuses existed, blamed some of these on mortgage brokers, and suggested that the increasing securitization of subprime mortgages was likely to limit the opportunity for widespread abuses. The report stated, quote, "Creditors that package and securitize their home equity loans must comply with a series of representations and warranties. These include creditors' representations that they have complied with strict underwriting guidelines concerning the borrower's ability to repay the loan," unquote. But in the years to come, these representations and warranties would prove to be inaccurate. Still, the Fed continued not to press its prerogatives. In January 1998, it formalized its long-standing policy of not routinely conducting consumer compliance examinations of non-bank subsidiaries of bank holding companies, a decision that would be criticized by a November 1999 General Accounting Office report for creating a lack of regulatory oversight. The July 1998 report also made recommendations on mortgage reform. While preparing draft recommendations for the report, Fed staff wrote to the Fed's Committee on Consumer and Community Affairs that, quote, "Given the board's traditional reluctance to support substantive limitations on market behavior, the draft report discusses various options, but does not advocate any particular approach to addressing these problems," unquote. In the end, although the two agencies did not agree on the full set of recommendations addressing predatory lending, both the Fed and HUD supported legislative bans on balloon payments and advanced collection of lump sum insurance premiums, stronger enforcement of current laws, and non-regulatory strategies, such as community outreach efforts and consumer education and counseling. But Congress did not act on these recommendations. The Fed Light provisions under the Gramm-Leach-Bliley Act affirmed the Fed's hands-off approach to the regulation of mortgage lending. Even so, the shakeup in the subprime industry in the late 1990s had drawn regulators' attention to at least some of the risks associated with this lending. For that reason, the Federal Reserve, FDIC, OCC, and OTS jointly issued subprime lending guidance on March 1, 1999. This guidance applied only to regulated banks and thrifts, and even for them it would not be binding, but merely laid out the criteria underlying regulators' bank examinations. It explained that recent turmoil in the equity and asset-backed securities market has caused some non-bank subprime specialists to exit the market, thus creating increased opportunities for financial institutions to enter or expand their participation in the subprime lending business." Unquote. The agencies then identified key features of subprime lending programs and the need for increased capital, risk management, and board and senior management oversight. They further noted concerns about various accounting issues, notably the valuation of any residual tranches held by the securitizing firm. The guidance went on to warn, quote, "Institutions that originate or purchase subprime loans must take special care to avoid violating fair lending and consumer protection laws and regulations. Higher fees and interest rates, combined with compensation incentives, can foster predatory pricing. An adequate compliance management program must identify, monitor, and control the consumer protection hazards associated with subprime lending." Unquote. In spring 2000, in response to growing complaints about lending practices, and at the urging of members of Congress, HUD Secretary Andrew Cuomo and Treasury Secretary Lawrence Summers convened the Joint National Predatory Lending Task Force. It included members of consumer advocacy groups, industry trade associations representing mortgage lenders, brokers, and appraisers, local and state officials, and academics. As the Fed had done 3 years earlier, this new entity took to the field, conducting hearings in Atlanta, Los Angeles, New York, Baltimore, and Chicago. The task force found patterns of abusive practices, reporting substantial evidence of too frequent abuses in the subprime lending market. Questionable practices included loan flipping, repeated refinancing of borrowers' loans in a short time, high fees and prepayment penalties that resulted in borrowers losing the equity in their homes, and outright fraud and abuse involving deceptive or high-pressure sales tactics. The report cited testimony regarding incidents of forged signatures, falsification of incomes and appraisals, illegitimate fees, and bait-and-switch tactics. The investigation confirmed that subprime lenders often preyed on the elderly, minorities, and borrowers with lower incomes and less education, frequently targeting individuals who had limited access to the mainstream financial sector, meaning the banks, thrifts, and credit unions, which it viewed as subject to more extensive government oversight. Consumer protection groups took the same message to public officials. In interviews with and testimony to the FCIC, representatives of the National Consumer Law Center, NCLC, Nevada Fair Housing Center, Inc., and California Reinvestment Coalition each said they had contacted Congress and the 4 bank regulatory agencies multiple times about their concerns over unfair and deceptive lending practices. Quote, "It was apparent on the ground as early as 96 or 98 that the market for low-income consumers was being flooded with inappropriate products," unquote, Diane Thompson of the NCLC told the Commission. The HUD Treasury Task Force recommended a set of reforms aimed at protecting borrowers from the most egregious practices in the mortgage market, including better disclosure, improved financial literacy, strengthened enforcement, and new legislative protections. However, the report also recognized the downside of restricting the lending practices that offered many borrowers with less than prime credit a chance at home ownership. It was a dilemma. Gary Gensler, who worked on the report as a senior Treasury official and is currently the chairman of the Commodity Futures Trading Commission, told the FCIC that the report's recommendations, quote, "lasted on Capitol Hill a very short time. There wasn't much appetite or mood to take these recommendations, unquote. But problems persisted, and others would take up the cause. Through the early years of the new decade, quote, the really poorly underwritten loans, the payment shock loans, unquote, continued to proliferate outside the traditional banking sector, said FDIC Chairman Sheila Bair, who served at Treasury as the Assistant Secretary for Financial Institutions from 2001 to 2002. In testimony to the Commission, she observed that these poor quality loans pulled market share from traditional banks and created negative competitive pressure for the banks and thrifts to start following suit. She added, quote, subprime lending was started, and the lion's share of it occurred in the non-bank sector, but it clearly created competitive pressures on banks. I think nipping this in the bud in 2000 and 2001 with some strong consumer rules applying across the board that just simply said, you've got to document a customer's income to make sure they can repay the loan. You've got to make sure the income is sufficient to pay the loans when the interest rate resets. Just simple rules like that could have done a lot to stop this, unquote. After Bair was nominated to her position at Treasury, and when she was making the rounds on Capitol Hill, Senator Paul Sarbanes, chairman of the Committee on Banking, Housing, and Urban Affairs, told her about lending problems in Baltimore, where foreclosures were on the rise. He asked Bair to read the HUD Treasury report on predatory lending, and she became interested in the issue. Sarbanes introduced legislation to remedy the problem, but it faced significant resistance from the mortgage industry and within Congress, Bair told the Commission. Bair decided to try to get the industry to adopt a set of best practices that would include a voluntary ban on mortgages that strip borrowers of their equity and would offer borrowers the opportunity to avoid prepayment penalties by agreeing instead to pay a higher interest rate. She reached out to Edward Gramlich, a governor at the Fed who shared her concerns, to enlist his help in getting companies to abide by these rules. Bair said that Gramlich didn't talk out of school, but made it clear to her that the Fed avenue wasn't going to happen. Similarly, Sandra Bronstein, the director of the Division of Consumer and Community Affairs at the Fed, said that Gramlich told the staff that Greenspan was not interested in increased regulation. When Bair and Gramlich approached a number of lenders about the voluntary program, Bair said some originators appeared willing to participate, but the Wall Street firms that securitized the loans resisted, saying that they were concerned about possible liability if they did not adhere to the proposed best practices, she recalled. The effort died. Of course, even as these initiatives went nowhere, the market did not stand still. Subprime mortgages were proliferating rapidly, becoming mainstream products. Originations were increasing and products were changing. By 1999, 3 of every 4 subprime mortgages was a first mortgage, and of those, 82% were used for refinancing rather than a home purchase. 59% of those refinancings were cash outs, helping to fuel consumer spending while whittling away homeowners' equity. End of section 19 and of chapter 5.